So by utilizing these high interest ETFs in your stock market portfolio, you'll be able to benefit from up to 5.5% interest tax-free if purchased in your TFSA. Hey, what's going on everyone? It's Griffin here, and for a couple of years, the rock bottom interest rates of the pandemic practically rendered high interest savings accounts and HISA ETFs completely useless, as who'd bother stashing their earnings in a savings account or a Canadian ETF yielding a mere, say, 0.5%, especially during the stock market's crazy bull run that we saw a couple years ago. But times have changed, and we're now facing some of the highest yields that we've seen in a decade, where investors can park their cash somewhere solid and rely on consistent interest income. So in today's video, we'll be covering 3 high interest ETFs that you can buy directly in your TFSA for tax-free, low risk, and consistent portfolio income. But first, what even is a high interest savings ETF? A high interest savings ETF functions as any other exchange rate fund, designed though to optimize the growth of capital through investments in a diversified portfolio of short-term interest-bearing instruments, mainly high interest savings accounts offered by the big banks, where unlike if you were to yourself go out and park your cash in a traditional savings account, well, a high interest savings ETF operates like any other ETF that you're probably familiar with. Essentially, the management company pools capital together and then invests across many high interest savings accounts, allowing the investor to then gain access to all of these high interest rates with higher liquidity, rather than having to go through the hassle of opening new high interest savings accounts every couple of months with different financial institutions to take advantage of the best rates possible, which are usually sign up bonus rates for a specified period of time. So this can become quite time consuming and daunting, finding the best HISAs and moving your money around. A high interest savings ETF is a great option to combat that. So with that covered and out of the way, let's take a look at a couple of great Canadian high interest savings ETFs that you can take advantage of as of today. The first HISA ETF is the Horizons High Interest Savings ETF, ticker symbol CASH on the TSC. Now, this is an ETF with a relatively unique approach where, unlike conventional funds, CASH diverges in its strategy by directly distributing interest payments from its deposit accounts to investors on a monthly basis, similar to what a monthly dividend ETF would provide investors. Now, a glance at CASH's chart reveals a steady upwards trajectory every month, which can be attributed to the distribution of its earnings. Subsequently, the value resets to approximately $50 per share, accrues interest throughout the month, and then reverts to $50 on its ex-dividend day. Now, despite yielding nearly 5.5%, CASH differentiates itself by offering monthly payouts, and it boasts an impressively low management expense ratio of just 0.11%, positioning itself as one of the most cost-effective high-interest savings account ETFs that's available in the Canadian market. Another key distinction lies in CASH's model that ensures the fund consistently trades close to its net asset value, that $50, with minimal variance throughout the month, typically within a fraction of a percent. So this means that the value of your invested capital remains relatively unchanged, while you get to reap the rewards of the high interest every month once it pays out that interest income. To sum it up, for those seeking a reliable avenue for generating monthly income through ETFs, CASH could be a great choice thanks to its consistent and predictable monthly payout structure. And if you're looking to invest in this ETF yourself, you'll want to consider doing so using a discount stock brokerage such as Moomoo. Hey, quick break here to mention a stock market investment platform called Moomoo that's been extremely popular over the past couple of years in the United States and abroad, but is only recently just launched in Canada, which I'm very happy about, as I've been waiting on this moment for years. So I wanted to mention it in today's video as it truly has an insane amount of free functionality built right into the platform for stock research. As we can see here in the Markets tab, Moomoo offers investors the ability to invest in equities and funds from North America, Asia, and Europe, making it an extremely versatile all-in-one stock market investment platform that also offers data and functionality for crypto, forex, futures, and bonds. They currently only offer cash accounts in Canada, but are rolling out the TFSA and RRSP over the next couple of weeks, so make sure to sign up to start taking advantage of their research functionality today. And by the way, they're running insane sign-up bonuses right now, reaching up to $1,500 in cash coupons for your deposits, with a minimum bonus of $20 for any deposit. So even if you open an account and deposit $1, you'll get $20 for free. Again, check out Moomoo down below in this video's description. The second high interest ETF that we'll be covering in today's video is the Horizons Cash Maximizer ETF, ticker symbol HSAV on the Toronto Stock Exchange, which stands out as a preferred choice among Canadian high interest savings account ETFs to choose from. However, it's essential to grasp certain considerations before making an investment in this fund. Firstly, it's important to note that HSAV doesn't actually distribute income, which can be particularly advantageous when held in a taxable investment account, so not a TFSA, FHSA, or RRSP. Here's why. Rather than distributing income as a distribution subject to taxation as interest income, which is a less favorable form of investment income tax-wise, HSAV retains the interest earned from these savings accounts and then reinvests it back into the fund, where this augmentation contributes to the fund's total net asset value, resulting in an increase in the share price, which can be seen on the fund's stock chart, where the value of the position itself increases rather than only fluctuating in the amount of the distribution every month, like with the cash ETF that we just looked over previously. So from here, investors can then sell these units for a profit down the line, triggering a capital gain rather than interest income along the way, which is among the most tax efficient forms of income available in Canada. So while the impact may be minimal in tax sheltered accounts, HSAV emerges as the optimal choice in a taxable account. HSAV boasts a yield of just under 5.5% as well, indicative of an expected annual appreciation in price around that percentage. And at the moment, its management fees hover around 0.15%. Okay, now a cautionary note regarding high interest savings account ETFs that I wanted to bring up though, is that while these investment options are generally accessible through various brokerages, it's also important to be aware of the fact that several major banks, including RBC Direct Investing, BMO, and TD's Direct Investing, may not actually permit direct purchases of these ETFs on their investment platforms. That said, based on my observations, HISA ETFs can typically be obtained at institutions like CIBC, National Bank, Canadian Western Bank, and Scotiabank, as well as through most discount brokerages like Wealthsimple Trade, Questrade, Moomoo, and Webull. The primary rationale behind this restriction is that the funds rely on the high interest deposit accounts held within these institutions in the first place, leading to the necessity of acquiring related investment products directly from the banks. Additionally, as briefly mentioned earlier, unlike with HSAV, pretty much every other high interest savings account ETFs that you'll find on the Canadian market, the distributions count as interest income rather than a dividend distribution. So interest income is taxed and not necessarily all that favorably. It's going to be added to your taxable income and you will pay your marginal tax rate on that interest income at the end of the year. So that's definitely something to consider, where if you're going to have a HISA ETF, you might want to consider investing in either your TFSA or an RRSP, and then using HSAV in a taxable account could be more beneficial for those capital gains where you're paying interest on it every single tax season. So investors are constantly looking for ways to create a nice return on investment, and considering the high liquidity, relatively low risk, and nice returns offered by HISA ETFs, these could very well serve as a portion of your fixed income positions even within your stock market portfolio. You can find a link to Moomoo and other discount stock brokerages down below in this video's description, as well as my full stock market investing course over on Skillshare that's completely free for anyone to join. Has over 7 hours of content directly related to stock market investing and over 1,700 students at this point. So check that out if you're interested. On that note, thanks a lot for watching, and I'll see you in the next one.